Imagine watching Bitcoin rocket toward like 82,800, looking absolutely unstoppable, and then bam.
Yeah, just hits a brick wall.
Right, the momentum just vanishes. So today we are diving into exactly who built that wall. We're looking at why the pure Bitcoin strategy might, quietly be dying. So let's unpack this. Was that massive price surge just, I don't know, an engine revving in neutral?
Well, it's actually worse than revving in neutral, to be honest. It was more like a rubber band snapping back. If you look under the hood, that peak wasn't driven by big institutions' buying spot.
Okay, so it wasn't organic demand at all.
Exactly. It was purely an algorithmic short squeeze. We saw about $400 million in synthetic short liquidity just completely vaporized.
Wait, 400 million?
Yeah, 400 million.
But I mean, if algorithms are suddenly forcing all those shorts to buy Bitcoin just to cover their losing bets, shouldn't that create a snowball effect? Like, why did it drop right back down to that 80,500 baseline?
Because once the forced buying stopped, there was nobody else in the room. I mean, the short sellers had to buy to survive, right?
Right.
But without underlying demand, there's nothing keeping the price up. It collapsed into a liquidity vacuum. And now, without that spot demand, we have around $4 billion in leveraged long positions sitting completely exposed.
4 billion, wow. Down in that 77,000 to 78,200 range, right?
Yep, right in that pocket.
Yep.
So if the price slips into that zone, we are mathematically primed for a cascading wave of liquidations.
So why did everyone suddenly leave the room at the peak? I mean, institutional money doesn't just vanish. That feels like a reaction to something way bigger.
Oh, absolutely. It wasn't a random Kirk at all. It was a direct mechanical reaction to a massive geopolitical repricing.
You were talking about the U.S.-Iran diplomatic memorandum falling apart.
Exactly. Markets had been pricing in this highly anticipated 14-point deal, and the mere prospect of it had driven oil prices down by like 12%. But then it violently collapsed.
Very publicly, too. Trump threatened intense bombing, and Iran basically dismissed the whole thing as a U.S. wish list.
Right, so what happens? Oil stops dropping. It stabilizes back around $90 a barrel.
And $90 oil means sustained inflation fears.
Exactly, which forces central banks to keep interest rates higher for longer. So systematic quantitative funds hit the brakes immediately. They had to de-risk.
Which completely explains the panic we saw in U.S. ETF inflows. I mean, they plummeted 90% in a single day, down to just 46.2 million.
Yeah, an absolute cliff drop.
And almost all of that fresh fiat was just monopolized by BlackRock's IBIT, while the others saw massive outflows.
And it's not just macro geopolitics doing this. Domestic regulatory shocks are, well, they're squeezing the ecosystem hard. Germany's a prime example right now.
Right, the move to abolish their 365-day capital gains tax exemption.
Yeah, getting rid of that is huge. I mean, we are predicting immediate geographic capital flight straight to the UAE.
Because investors are trying to lock in tax-free gains before the wall hits.
Exactly.
Yeah.
And meanwhile, in the U.S., you've got the Clarity Act pushing that strict July 4th deadline.
The one banning passive bank-like stablecoin yields.
You got it. So regulators are attacking from both sides.
Which brings up a really fascinating point. With all this sovereign policy friction, is this hostility actually forcing companies to abandon the pure-play Bitcoin treasury?
The data strongly says yes. Companies are realizing they need a multi-asset defense. Take Hyperscale Data, for instance.
They hold, what, 680 Bitcoin?
Right, but they just explicitly pivoted to buying physical gold and silver to sit right alongside it.
Wait, really? Gold and silver?
Yeah, and the pivot goes beyond just the balance sheet. Look at CleanSpark. They have this massive 1.8 gigawatt power portfolio.
Right, a huge mining operation.
Well, they're actively pivoting away from pure mining and reallocating into high-margin AI computing infrastructure.
Wow, so the asset really is trapped right now, like pinned between algorithmic derivative limits on one side and sovereign policy friction on the other.
Yeah, it's forcing even the biggest believers to diversify.
Which leaves you with a really critical question to mull over. With mining giants pivoting their hardware to AI and corporate treasuries blending crypto with physical gold, is the era of the pure Bitcoin strategy officially dead, replaced entirely by multi-asset macro defense? Think about it. We will catch you on the next deep dive.